Earnings season has arrived. It's been a volatile start to 2022 to say the least, but the first half is now in the books, and investors and analysts are looking for earnings reports coming through in this season to give an insight about sector and company performance. We've seen many of the leading names report. This was a big week for mega cap technology names. Apple and Amazon are still yet to report at the back end of this week. But today we're going to unpack some of these headline reports from the consumer space, the technology space, and some of those leading global blue chips, and take away some of the insights across them all. Some have missed expectations, some have beat, some have continued to deliver, while others have disappointed. Today, these are the stories we're going to unpack.
Sit back and enjoy.
Alrighty, so kickstarting us off, we've got Walmart. Walmart, of course, is one of the leading bellwethers for consumer companies around the world. We know that Target over this past period has issued some profit downgrades. This sent shockwaves throughout the retail sector. And this time it was Walmart's turn. We can see here Walmart shares slumped after the company cut their profit expectations. This had to do with the inflation concerns. We all know about the inflationary pressures on the raw material side due to the supply chain bottlenecks, as well as on the labour shortage side as well. What we're seeing, and this is not a surprise to anyone, but it is fascinating to see it flowing all the way through to the consumers as the Federal Reserve and other central banks raise interest rates, look to curtail demand, and of course, hopefully navigate the soft landing without inhibiting growth too much. But we're seeing that with all of the inflationary forces, shoppers are now spending more on food and of course, gas bills, energy, all of that, and less on your discretionaries, so your electronics and your other discretionary categories. This is not isolated to Walmart. We've seen it flow through with other reports from different indices around the world as well, but Walmart was that first initial one. And we've seen aggressive markdowns on items such as clothing are also hurting margins. We know about the inventory bloat that we saw with significant ordering at the back end of last year, and this is starting to impact, particularly if they have to continue to discount further to try and clear through that. Walmart shares fell, as did others, including Target and e-commerce giant Amazon. Just looking a bit further below the line as well, shift in spending has left more on items on store shelves and warehouses. Big box retailers now have to aggressively mark down items that customers don't want. Walmart is the biggest grocer in the US. They're obviously considered a bellwether for the overall economy. We're seeing consumers move towards staples. And what's fascinating as well in terms of the consumption mix is we also start to see this mix away from goods towards services. So it's going to have impacts for the different sectors that will be beneficiaries, potentially those beneficiaries in 2020 and 2021. And now that transition to who may be the beneficiaries coming out of this next stage of the cycle. Increasing levels of food and fuel inflation, companies seeing strong back to school sales, but they're anticipating that people will pull back on buying general merchandise in the second half of this year. And then we can see these types of spending habits flowing through as well through companies like Snapchat as well as Meta's earnings. Now you might be wondering, how can a technology company like Snapchat, social media companies, provide us an insight into spending habits? And that's because all of their revenue, the majority of it is derived from advertising-based revenue. And of course, during good times, during boom times, companies have got a lot more funds ready to spend on advertising. However, during times where they may need to hibernate or they may need to cut down on spending, obviously to try and maintain their earnings margins, then marketing can be one of those first initial things that firms look to cut back on. As a result of this, Snap shares plunged by over a quarter. They missed both on the top and the bottom line. And they're also substantially slowing their rate of hiring. We've seen this as a trend flowing through in many of the technology companies who'd hired significantly during the boom periods, but of course they're needing to cut down now as they look to maintain profitability or move towards profitability, as the market's now prioritizing profitability and cash flow ahead of just growth at all costs. Having a look here at some of the insights that they've provided below the line, Snapchat, they're not providing guidance for the third quarter, incredibly challenging. We all know about that. Revenue so far this period is extremely flat from the third quarter, but analysts were expecting sales growth of 18% for the third quarter up ahead. Company have stated they're not satisfied with the results they're delivering regardless of the current headwinds, so they want to do better. And just having a look through here at the bottom line, what we know is the challenging economy, the iOS update, which obviously makes it difficult to target. We'll talk about that with Meta as well. And competition from companies like TikTok have all led to a pullback on spending. Snap have identified relatively healthy businesses were curbing their commitments on advertising because of the input cost pressures due to inflation. Companies want to keep healthy cash balances so they're able to navigate and be flexible during this period. And in certain higher growth sectors, businesses are reassessing investment levels amidst the rising cost of capital. Money's not free anymore and potentially may get more expensive. We just saw a 75 basis point rise, and this is being further reflected in campaign budgets and the levels of bids per action. Flowing through here to another peer in the social media space, Meta, the parent company of Facebook. They've lost over half of their market cap this year. It's been a difficult period for them. Revenue miss, it's actually a declining revenue period, which doesn't often happen with Meta, and the forecast is second straight quarter of declining sales. Missing on both that top and the bottom line, guidance reflects continuation of the weak advertising demand environment. Having a look at some more of the insights that they provided. What's interesting, they actually beat on the daily active users front, didn't miss too much on the monthly active users, so users are still there. And we saw a similar trend with Snapchat as well. The users are there, people are using it, but it's actually the spend on advertising and the actual revenue being derived from this that is actually lower, and obviously profitability comes lower as a result of that too with the earnings. So Mark Zuckerberg, on a call with analysts, discussed the continuation of the weak advertising demand environment experienced throughout the second quarter, being driven by the broader macroeconomic uncertainty. Period demands more intensity and expects to get more done with fewer resources. So it's all about efficiency now from these companies. We saw a similar type of focus from Microsoft. They actually missed estimates, but their stock was up by 5%. And this is because with some of these past results that we saw over the past couple of weeks on the tech side, sentiment was already relatively low. So Microsoft missed, but the stock went up, fell short. Company's revenue from Azure, we know the cloud service is a big growing sector. AWS and Azure is massive for these two leading names, and changing exchange rates and challenges in advertising in the PC markets brought down revenue in the quarter. A lot of revenue derived from outside the US for Microsoft. So with respect to guidance, Microsoft called for $49 billion to $50 billion in the fiscal first quarter revenue. The middle of the range implies about 10% growth. It's crazy to think about the fact that this is a company like many of the mega cap technology names that even when they're missing or just coming in at the bottom end of kind of their expectations, they're still growing at double-digit growth. They're almost unparalleled in terms of their ability to grow, to scale, and the pricing power they have. And this flows us into the next discussion that we have. We've seen a few companies missing, a few uncertainties in the macroeconomic environment. Well, what's working at this current time? And it flows through from Microsoft, but it's companies with pricing power, with strong balance sheets that are well positioned. We look at one example here, Coca Cola. So their earnings top expectations, sales volume starting to recover. Obviously, when everyone's staying at home, less Coca Cola is getting bought. Higher revenue that topped analyst expectations, but revenue was driven by pricing increases. Obviously, when you're growing your revenue, you've really got two levers you can pull. You can grow, you can increase your prices, or you can increase your volumes that are being sold. But here we're seeing that both of these were increasing from Coca Cola. Even though they're facing higher costs for key goods, they're able to continue to grow and beat on that top line. So quarterly earnings topped expectations as their sales at restaurants, theaters, and other venues recovered. I'm sure you've got many friends and families who have been eating out, traveling, maybe they're out on an adventure. We're currently here in Lisbon, in Portugal at the moment. We're out traveling as well, and I've got to say that I've had a couple of Coca-Colas, even at a theme park that we're at just recently. So I can definitely see these trends flowing through in the real world as well. And then building on that as well, another company with a strong balance sheet and pricing power that also beat was McDonald's. So they've stated that higher prices and high value items have helped boost their US sales. Revenue fell short of expectations, but earnings, so the profitability side, managed to top estimates. Net sales dropped by 3%, obviously affected by the Russian and Ukrainian situation there, which they've drawn out. Global same-store sales rose by 10% in the quarter, fueled by strong international growth. So it's a difficult environment, but they've been able to raise their prices and continue to see no significant reduction in terms of demand. So they've been able to be strong on that bottom line, despite everything that's playing out. And they've got their value items as well. I'm sure you've seen the penny pinchers menu, depending where you're tuning in from around the world. McDonald's and many of these other fast food chains have been rolling out the penny pinchers menu, but also driving prices higher on the top line. There's plenty going on. We've started to see some earnings. Apple and Amazon are really going to attract a lot of eyeballs at the back end of this week. The Fed's just raised rates. There's still a lot of uncertainties, however. We'll be watching the US GDP figures too. Drop in a comment below which earnings reports attracted your attention. And most importantly, where do you think markets are positioned and will head moving into the back half of this year? We've just dropped this second channel. For Investors is now live. Subscribe, turn your bell notifications on. Big thank you for joining us. And for now, stay well and happy investing.